Are we on the cusp of a bond bear market?
Well, I'd say we're in sort of a mini bond bear market already, because, as you say, it's very unusual to get drawdowns in excess of 2 or 3% in the bond market, and kind of writ large. So when you're down 5%, it certainly probably qualifies as a bond bear market. Now, we're not in the camp that says this is kind of regime change and we're going into a 10-year bond bear market, or even perhaps a 1-year bond bear market. But we've certainly seen a significant decline now, as you would expect when you start to see rates move the way they have.
Lisa, under CFA Level 2, a bond bear market is defined by when you open your monthly statement 3 months in a row and it's south, that's a bond bear market.
Right, and the question is whether that's a self-fulfilling prophecy, whether people see the red and they withdraw more cash, or whether some people say, you know what, we want to hide out in some of these securities, especially if we are concerned about the consequence of rate hikes. And Kathy, that has been part of your thesis. How much are you continuing to double down on that duration call?
Yeah, we've had a short duration call for, really a long time, probably a couple of years now. We're actually starting to advocate taking on a bit more duration as yields move up. So one of the things we see is you get into a rate hike cycle, the yield curve flattens, you get 2s, 10s below about 50 basis points, and you're probably pretty near the peak in 10 years. So as we get into the rate hike cycle and we see that yield curve flattening, we're actually advocating starting to take on a little bit more duration, not jump into 30-year bonds here, but to start to add to that duration, because there's nearly the market's gone a long way already to build in this rate hiking cycle. We're already seeing financial conditions start to tighten a little bit, so we're on the verge of probably hitting at least an interim peak.
All right, in an interim peak, but can you sit on that for just a minute? We have that 10-year yield now at the highest levels going back to late 2019, 1.94%. This is a near-term peak, an interim peak, but do you think that this is the peak of the cycle?
Probably for this cycle, if the Fed and the other central banks follow through on what they're saying they're going to do. So we think this cycle is pretty powerful because it's globally synchronized. The Fed is using both quantitative tightening and rate hikes to bring down inflation and to slow the economy. Fiscal stimulus is already a thing of the past and will fade. So as we look out over the next year or so, which is probably defined as the cycle here, we think that we're probably fairly close to the peak in longer term yields.
Kathy, you point to some data, economic data, showing that actually you are starting to see a slowdown in the pace of the economy. Can you give us a sense of the slowdown in the economy versus the slowdown in inflation, and whether it makes a difference for the two?
Sure. So typically some of the signals that we watch are like the global PMIs. They're starting to roll over. We're seeing personal consumption expenditures start to ease up, which isn't too surprising because the fiscal policy boost we got is waning. And those are indicators that usually precede the peak in inflation. So we all know inflation's a lagging indicator. And so there's also the problem that as oil prices move up and gasoline prices move up, it erodes consumer spending power. So our thesis is that we're getting into a slowing economy as the year plays out, and as a lagging indicator, inflation will come down as a result.
It's nonlinear. When we come from 7%, Kathy Jones, down on inflation, as is widely presumed, what's a single point trip point for psychology? Under 4%?
I would think so, although I will point out that certainly the market-based expectations for inflation haven't really moved up that much. On the retail side, or when we look at, say, the University of Michigan Consumer Sentiment Survey, those have become more elevated, although really the long-term outlook isn't for much more than 3%. But I'd say the trip point in terms of psychology in the market, if I had to name it, would be gasoline prices. People are very sensitive to what it costs to fill up the tank every week or whenever. I don't know. I don't drive, so it's not an issue for me. But people are very sensitive to gasoline prices and, of course, food prices. So if we start to see those gasoline prices come down later in the year, I think that will change some of the inflation fears.